JD.com is a fast-growing online retailer based in China that has its headquarters in Beijing. It is also part of the Fortune Global 500 and is a major competitor against Alibaba. It all sounds great, but is it a buy in 2019? First, let's talk about JD's growth rates. Its revenue is currently growing 16% year over year and is expected to grow 18% year over year in the future, which is pretty fast. However, this is not the impressive statistic of JD, as Alibaba has their revenue growing 40% year over year right now and is expected to grow their revenue 34% year over year in the future. What is something to look for in JD is the transition of turning revenue into profits, as they actually have more revenue than the retail giant Alibaba, which is usually around $4 billion more than the revenue Alibaba has. Due to the transition of actually losing money to producing money, JD has its earnings growing 145% year over year right now, and is expected to still grow their earnings 22% year over year in the future. These numbers of growth are all far higher than the sector median for growth, as the sector median for revenue growth is at 3% and the sector median for earnings growth is just 5% year over year. It is true that JD.com is actually slowing down on every line except for earnings, but increasing earnings can actually be the key to accelerating growth on every other line, as JD.com will finally be able to pay off its $17 billion worth of liabilities that has grown over the past years. Once these liabilities are no longer a huge problem, JD.com can finally work on marketing their business into taking some market share of Alibaba. Because JD is still in the earnings transition phase, their PE ratio is extremely high up at 86, which is far higher than the sector median of 16, and its forward PE ratio is at 43, still far higher than the sector median of 17. However, this ratio is going down at a tremendous rate, as seen with the comparison of its PE ratio and its forward PE ratio. Yet what is intriguing is their price to sales ratio, which is currently at 0.58, far lower than the sector median of 0.89. Along with that, it's still expected to go down to 0.52, far lower than the sector median of 0.84. All this growth sounds great, but what about the US-China trade war? The US-China trade war, combined with the slowdown in revenue growth JD has seen, has absolutely destroyed the stock price and brought it far below the S&P 500 performance. But this actually provides a great discount for the stock. Trade talks are also resuming and we could see the situation get better. As Warren Buffett says, you must be greedy when others are fearful. It is true that Trump could be bluffing the trade news to make it sound like the deal is getting closer, but if the situation gets worse, it really is just another buying point to buy JD stock. The market in general is extremely high up right now, and it's a great time to hold cash, just like how Warren Buffett is right now. But the prices in JD right now really aren't too bad at all when comparing it to its sales. It definitely could be a little overvalued like the whole market is currently, but in comparison to some other stocks, it's actually pretty undervalued at this moment. Now, when it comes to analyst ratings, the majority of analysts are actually pretty bullish. There's no bearish analysts whatsoever. The average analyst rating is at outperform, which is a rating of 3.85. Along with that, the average price target right now is well above the current price of 29, as it's at 33 currently. Overall, I would rate JD.com at a buy because their transition to earnings has lots of potential going forward, and their price in comparison to their sales is fairly low. However, I won't rate this a strong buy yet because I believe the price could go down more in the short term. If you enjoyed this video, please subscribe, like, and comment. It really helps out. And as always, thank you guys for watching.